Good morning. This is Clemens, and we'll be talking about the business cycle. I'm going to be looking at the most important things that are involved when somebody is contemplating starting a business or they are starting a business. I will look at the most important aspect of a business, or rather, one of the most important aspects of running a business, which is accounting and bookkeeping. Well, accountancy, the definition of accountancy is the production of financial records about an organization. The end result of accountancy usually is accounting statements that show in money terms the economic resources under control of management, selecting information that is relevant and representing it faithfully. The principles of accountancy are applied to accounting, bookkeeping, and auditing. That leads me to the second point. Bookkeeping is simply recording the financial transactions of a business, and accountancy is a step up, which actually involves analyzing those recordings or extracting those recorded transactions for business to come up with a full and better picture of a business. And bookkeeping is the primary activity in a business to capture all the events that happen in a business. A transaction is an event that takes place in a business, whether in its day-to-day running or once in a while, like sale of non-current asset or fixed asset. That is a transaction. Anything that actually happens that is a monetary value and sometimes non-monetary value, especially when there's an exchange for one thing for another thing in a business, but they have to have monetary value in order to be involved or included in the accounts. I'm going to give you a few more definitions, and then we can begin to look at this in greater detail. First of all, talk about asset. An asset is what the business owns, is an item that a business owns. Usually there is a misconception between what the business and the business owner owns. But let me clarify that issue. If you are running an established business or a limited liability company, there is one thing that is of vital importance actually to know. The business and the owner are two different entities. That is why we have companies having names named after their own and people having their own names. In the event of folding or liquidation, the person's personal items or assets are not claimed by the debtors or whoever the company owes in order to satisfy those liabilities. The person's personal property is their property and does not have to be repossessed in the event of liquidation. And on the same token, the business owns whatever it owns that is under its name that was purchased under the business name. And the owner has no right to come in at any moment of time and take what the company owns for their personal use. This is quite usual in sole traders or partnerships where we have people who own those businesses or run or finance the operations of that business coming in to take from the business. And that is called drawing, taking from the company. And that reduces the capital, which is the initial amount invested in capital. So your profit distribution also reduces at the end of the period. So having said that, I'm now skip to liabilities. Liabilities are what the business owes other people or other businesses, and they may be in the form of when you go and buy, say, make purchases, goods for resale from another business, and you have not paid cash. You have incurred a liability. You owe the business that you have bought from, and hence you have to pay after a certain period, according to the agreement that the business has with the other business that he is selling them those things in credit. And finally, I'm going to talk about capital. Capital is the money or things that are used to start a business. Simply put that way. Having said that, I'm gonna talk. I'm gonna go on to look at the major business equation. No matter how large a business is, no matter how established it has become, any and every business will always follow and observe this equation. Assets are equals to capital plus liabilities. I'm going to explain why. And before then, let me say this. At every given moment, if a business is practicing proper bookkeeping principles, the capital is always going to be equal to assets minus liabilities, or the assets are always going to be equal to capital plus liabilities. Why is this so? It's simple. Imagine a business has, imagine a person is starting a business and they have $5,000 cash. That money they put into the company. Once that money has been put into the company, it becomes an asset, the asset of cash. They can either put it in the bank or they can keep it as cash in liquid form. And so capital at this point is equal to assets. And there's no liabilities. I'm just talking about a person having put their money into the business. The capital is equal to the $5,000 cash. So if we go back to the equation that I've said a little bit earlier, I said assets are equal to capital plus liabilities. It becomes assets $5,000 are equals to capital $5,000 plus liabilities 0, which balances out. Let's look at another example. A business begins and a person has $100 worth of stock, plus he goes on to buy 350 more stock on credit. He has incurred a liability in the process of buying on credit. So the goods that were there worth $100 cross over to the other side of the equal sign and become an asset. The goods that he went on to buy on credit, not paying by cash, cross over and become 350 plus 100 that was already there. So we have $450 worth of assets, which equals to 450 equals $450 worth of stock, which is broken down into a liability of $350 plus the stock that was already purchased, cash, $100. So that becomes the capital of that person. I might give you another example. Let's look at it this way. If a person comes in with a car worth $5,000 and buys goods worth $200, so the car becomes the capital, the goods become the capital. So $5,200 are equals to assets. The car becomes an asset in the business, and the stock is an asset in the business. It's a current asset. So whatever is done at the beginning of business, whatever is put on the very first day of operations is capitalized, is actually capital, is included in the capital figure. Rather, if it is not stock, if it's not stationery, if it is not office equipment, if it's not anything, it's included in the capital. See? So at any point, assets are equal to capital plus liabilities. And in most questions, in most exam questions, they will tell you that this is capital, this is a current asset, this is a non-current asset, this is a bank amount of this much, but they'll always tell you what is capital, what is not. And at the end of the day, when you make a balance sheet, you have to have two sides balanced, because the balance sheet is just an expression of the accounting equation. You have the asset side, and then you have the capital plus liability side, and they always have to balance at any given moment. If the bookkeeping records have been maintained properly and accounting has been done. You have extracted the proper balances from the um, T accounts, trial balances, whatever it could be, the preparatory work that you put into producing the final accounts. And the final accounts include the cash flow account, the trading account, the profit and loss account, the profit and loss appropriation account, plus the balance sheet. And that actually gives you a full set of final accounts. And people who want to know and use the final account, we have the internal final accounts where a business owner will want to sit down at the end of a period, and because everybody wants to monitor their progress, unless of course if you're in business not and you don't care about the business. But if you care about the business, you always want to know where you're coming from, where you're going, what's the performance of the business, how is the asset utilization ratio, how is the capitalization ratio, and how much profit did you make in a certain period. Because sometimes, in many cases, we have business owners or business people that come in and see that they have cash in the bank or cash on hand, but that cash may not be a profit. It's just cash that's sitting there that you need to analyze and see if you have actually covered what you spent in order to generate that cash, or you still owe. That's why many businesses fold at the end of the day, because people do not balance things up, because accounts help you with budgeting, accounts help you with planning for the future. They help you see how much you owe and who you owe, and if your business is going up or down. You know, so whatever you do with the accounting ratio, you can put liabilities on one side. Liabilities are equals to capital minus assets, or capital is equal to assets minus liabilities. But the easiest thing is assets are equal to liabilities, and then you work from there. This is just a mathematical equation that you can actually juggle around with and come up with something. And one more thing to stress: capital is always a liability to a business, because the owner will put the capital into the business, hoping to get profit from it. Whenever you invest, it's like an investment. When you invest on mutual funds or hedge funds, whatever, you are expecting a profit on your initial investment. Similarly, if a business person puts money into their business, they expecting to rip, and they rip in the form of profits. If you are a shareholder, you rip in the form of dividends, which burns from the profits that a business made. You know, so it always has to be the case. You have to get your dividends, you have to get your profits. In a partnership, it's called share of spoils or share of profits at the end of a period, when in the appropriation account, after having accounted for assets, for expenses, you have to have some remaining. The excess of income over, expenditure is the one that's appropriated between partners in accordance to their capital contributions, and hence a ratio that would have been established at the beginning of the trading period. You know, so when events occur in a business over its life, during the course of business, they're recorded in different books that include journals, T accounts, you know, and the different types of books that are used for different types of accounts. And before we can go deeper into looking at the journals and everything else, I want to introduce you to just one of the most vital things that you need to know when you have to record transactions for practice or in reality, and this is called a T account. A T account is a form of an account where we have different accounts. When we start a business, we have to open these T accounts that we balance at the end of the month, and whose balances we extract to the trial balance. A trial balance actually is used to collect the balances of all assets and liabilities. And at the end of the period, capital and liabilities are on the credit side, and all assets and expenses are on the debit side. Included also on the credit side are revenues, sales, sales is an income, is a revenue and always has a credit balance. So, well, you'll understand this a little bit later when we've looked at some examples of the T accounts and how best we can do. But a simple T account looks like this. It has an account name at the top, and it's divided into two pieces, two equal halves. One side is the debit side, which is the left side, your left side, you know, and one side is the right side. So this is your right, this is your left. So on your right, we have the debits. On my left, we have the debit side. On your left, on my right, we have the credit side. So if it's an asset account, to increase assets, we always debit in the asset account. We go and write the reason why we increase that account, write the amount that we increase that account by. When we decrease an asset, when we sell, or anything that causes us to reduce the amount of an asset in the business, we credit it. So we put it on the left hand side, on your left hand side, on my right hand side. That's where we write the date, description or details, say date, disposal of an asset, $5,000, 0 cents. That's it. We buy another motor vehicle, 25 June, cash, or if it's on credit, you write the name of the person or company that sold you on credit, and you write the amount. At the end of the month, we balance up, and usually all balances of assets are carried down on the credit side and brought down on the debit side. And the brought down balances are the ones that we transport and put on the trial balance on the debit side. And similarly, liabilities and revenues. To increase liability, you always credit. So that's on your left side, on my right side. So you write the date, and maybe wholesalers, $15,000. When we buy stock on credit, you go to the purchase account, then you write the date, who has given us that credit line, the amount, you know. And if we pay, when we pay them, we go to their account, the specific creditors account, and we always debt. But don't worry much about it. As soon as we get to it, I'll start demonstrating, and using demonstrations, it's gonna be a lot easier when you have something that you're looking at, and it'll be fun, I promise. So basically, to recap, what I was talking about today was just the business cycle, looking at accountancy. What is accountancy? Systematically extracting information from the accounts in order to come up with the final accounts that are used by stakeholders. And stakeholders is anybody with an interest in the business. It could be a rep, I'm just kidding. It could be the government authorities, the tax officials that need to see your final accounts. It could be investors that need to see final accounts. Sometimes when companies want to issue shares, people need to see the performance of that company over a period of years. And instead of burdening people with all these books of accounts, like, you would rather present information packaged into one set of accounts, which is the final accounts, which give a true reflection of accounts. There is a need to be truthful whenever you're reporting to stakeholders, because, just for example, what happened with Amber, there were window dressing accounts, presenting those high value figures and presenting a lucrative side of a business, even if it's not, even if it's a lie. A lot of businesses window dress when they want money from the bank, when they want people to put money in there. They just, sweeten up things, make them look very lucrative, while on the ground, or in actual fact, it's not the truth. So there is need to maintain the accounting ethics, and the accounting ethics, when flaunted, is a criminal offense. But you cannot lie to yourself, because there is internal accounts and external accounts. Internal accounts have to report to the owner of the business. You have to sit down and reflect and ponder and discuss with your board, your advisors, so that you can draft a way forward. And it is very important for every business owner to produce accounts, no matter how small or large their business is. Everybody needs to see what is happening. Otherwise, you lose through pilferage, you lose through squandering of money by employees, or yourself, or you may just fool yourself that your business has money or is operating well, when in actual fact it is not operating well at all. So it's quite vital to make sure that accounts are properly managed and properly uh, presented to whoever has to take a look at those accounts. So we spoke about the accounting equation. Assets equal are always at any point, at every and other point, accounts assets have always to be equals to capital plus liabilities. Otherwise, the equation doesn't balance. We did arithmetics. We did equations. They have to, one side of the equal sign always have to, it has to be equal to the other side of the equal sign. So, whatever you do, just try and make sure that it's always like that. Find the mistakes that there may have been omissions, there may have been mistakes in addition or anything that makes things not to balance at the end of the day. But the most important thing is that, and transactions are events with usually with a financial value or financial implication of business that occur during the day-to-day running of a business. You know, for now, I'm gonna stop here, but I'll be back, and when I'll be looking at what an account is, we will start from looking at what an account is, and from there on, we'll go forward and make entries, adjustments, and finally, we get to do the final accounts. It's gonna be a lot of fun, trust me. This is a very good job or field because it's what I love to do, and hopefully you're gonna have fun and you're gonna enjoy. So the best thing you can do is to enjoy, even if you're not, but you will definitely.